Hey, I'm Bill Faeth. Welcome back. So this guy right here is Ryan Bakke. He has learned like a CPA on every social platform, and Ryan has single-handedly saved me close to $2 million. That's $2 million since I've known him over the last 2.5 years. It doesn't matter that I'm going to be 51, Ryan, in 2 days, and he's like 25, right? So I'm double your age. Are you 26 yet?
26. It's
So he's
26.
just, he smiles. He just turned 26, but he's a fucking whiz when it comes to tax. And that's what we're going to talk about today. Because whether you're an investor currently or you're thinking about investing into real estate, there's a lot of misconceptions that are out there. One of the reasons that somebody like me continues to invest is because I need those tax benefits so I don't have to pay as much to Uncle Sam. Ryan and I were just talking about before we started recording that literally I'm sitting on about $171,000 in a due refund because I paid in based on what happens with the current cost segregation bill that's delayed in Congress. And I think Ryan, you and I are of the same opinion. That's probably not going to get done before the election. Do you agree?
Yeah, I agree. And I think the GOP, I think the Republicans are planning on a sweep in the election, and then they're going to come back and try to pass the bill after the
And the thing that
election.
sucks is it's really about the child tax credit between the Dems and the Republicans. It has nothing to do with, Section 179 or cost seg benefits or accelerated depreciation, right? We're just caught in the crosshairs with that as real estate investors.
Yeah, anytime there's a bill in Congress, each side's trying to throw stuff in there, and the child tax credit is really what's hanging up for the Republicans to get the bill passed. They really don't want the child tax credit to be increased.
For the commoners that are out there like me and you, we watch movies and we about politics, and they're putting in the pork and the fat into these bills, and that's essentially kind of what happens here. Is they've got this hang up, and I think the child tax credit's a pretty big deal, but hopefully we'll be able to get that resolved. So somebody like me, I have an extension. I've already paid, so where the government now owes me potentially, if it goes from 80% back to 100%. So if they retroactively go back in 2023, $171,000. What do I do? I'm 51. I'm financially secure. I've already paid that. Do I just go ahead and file now, or do I wait? And I mean, I'll give you a caveat. Because of 2024's income, I need to buy probably about $2 to $2.5 million worth of real estate based on the 60% for this year.
Hmm. Yeah, well, I'll give you some situations. So if you are due a refund, if you do the calculations and you know that the government's going to owe you money, you're not required to file even by the extension deadline of October 15th. If the government owes you money, they owe you money, and it doesn't matter if you file in October, November, December, or whenever. The problem is, that should be your money, right? Let's say right now you're due a refund of. We have a client where she's due a refund of $33,000. But with the estimates, if they do bring back the 100%, well, then she's going to be due a refund of $38,000. So it's an extra $5,000 if they pass this bill for her. But if that person really needs the money now, well, then they're going to file now and they have to amend the tax return later. The problem with amending later is that it is going to take the IRS. It easily takes the IRS right now almost a year to process an amendment and get you the money back. And so that means, especially if everybody else is amending their tax return at the same time for the same reason, it could take 2 years for them to see that additional $5,000. So depending on your financial situation, if you can wait it out, maybe it is best to wait out till post election. But if you can't wait on that money, then maybe you file now and deal with the amendment later.
A lot of considerations that go into that, right? So, I mean, for somebody like myself, I would just defer that to, quarterly payments anyways, right? Or pay in for next year. So I don't need to pull that cash out. Is it the same thing? I mean, I'm probably going to wait till September 15th. I think that's when my single members are due for filing, right? So I'll probably wait till then, around September, to see what the status of the amendment or of the bill is, and then decide if I'm going to file or not. But I think one of the other considerations is a lot of people probably aren't as astute as you and I are about the banking situation. So if you went from making $100,000 a year in 2022 to 150 in 2023 with added rental income, added bonuses, W-2 increase, whatever, and you need that extra $50,000 of income for buying power, then you probably shouldn't wait, right? Would you agree with that?
Yeah, and that's another point too. If you want to buy a property with the Fannie or Freddie, especially conventional underwriting, they're going to require to have that file tax return regardless. But I do agree that you're going to need to figure out what the financial situation warrants. Like if you're going to be buying property in the near future, then you're more likely to file that tax return sooner.
I think a lot of people don't understand kind of how that works. So there's way more to this, and we're going to talk about 1031s here in just a second. But on what we do with our tax return right now, because and I want everybody to know, all of us are in limbo. Ryan, I'm sure you're waiting to see what happens. You bought property last year. I bought property last year.
Yeah.
Those of you listening most likely bought property. So you really need to figure out your own situation. Here's the advice that I'm going to give to everybody that's listening and watching. If you don't know, reach out to Ryan. Reach out to, he's Learn Like a CPA on every channel. You can find him in my Facebook group. He's got his own Facebook group. Reach out to somebody like David Perez, Brandon Hall, Ryan Bakke. Your standard, CPA most likely is not going to be able to give you advice. Here's the difference. Ryan is an investor just like you guys, right? And he is a multifaceted investor. Laundromats, salons, like these multifamily, unique properties, single family homes, and he's a CPA by trade. He knows what you are going through. Most of our CPAs are not investors. They may read the tax code and understand the short-term rental loophole, but they don't really get it to the degree that we do. Most of them have no fucking clue about the banking situation. And that's something you need to talk to a Brenna Carls at the Mortgage Shop, or a Parker Borowski at Movement Mortgage, or Brian Buckhold at Huntington to discuss these things. So I think that's a lot of stuff. I appreciate you kind of taking some time and just jumping on here and, with 10 minutes notice to go over this, because I think this is really important stuff that we're all dealing with. And I'm sure you're getting a million questions about this, as I am. I want to jump over to 1031 exchanges real quick. And you and I have a client that's going to become one of your clients, and she's in a unique situation, or she thinks it's a unique situation, but you and I know it's much more common for people. And I think as Gray is understanding where we're at financially, what our plan is from an investment side, are we purchasing for that cost sake? The same thing applies with 1031s. So why don't you just give the breakdown and start with the definition of a 1031 and a poor man's 1031, and what the differences are. And then let's talk about application after you go through that.
We had to change the name of the poor man's to the lazy. We call it the lazy 1031 now. We had some gender.
It could be it could be the millennial 1031 too, or the Gen Z. It could be the young person's 1031.
We had some complications with the terminology. So
right.
The Dave is now the lazy 1031.
Okay,
so
gotcha.
An original 1031 exchange, you can almost think of it like if you're playing Monopoly when you trade up the 4 greenhouses for the Big Red Hotel. It's taking the equity from one property, the proceeds from one property, and rolling that into another property of equal or greater value in order to defer your capital gains. So if you bought a long-term rental in California 10 years ago, and you bought that, let's say you bought it for $250,000, and now it's worth $400,000 or $500,000, and you don't want to pay the tax bill when you go to sell it, well, you can 1031 that into another rental property. And it doesn't even have to be the same kind. You can go from long-term rental to short-term rental. You can go from short-term rental to commercial. You can go from short-term rental to long-term rental or to multifamily. It doesn't matter what asset class. It just has to be real property, and it has to be real estate. And by doing that, you're able to defer, and you're able to kick that can down the road. So instead of having to pay those taxes now, you're kicking that can down the road and paying them at a later time. And I think that's what we're talking about. Is it's almost like a ticking time bomb, right? At some point down the road, if you mess up, there could be a tax bill due on that 1031.
Well, I mean, it's an even bigger problem when you do it multiple times. Or like me, I'm in a situation. It's not bad because of my personal financial situation. I sold a property in Gulf Shores, like right when I met you, right? I had $640,000 in a basis, a net gain on that property. I 1031 I split it into 2 properties, my Big Banner Elk property, right? And then I bought the Beach Mountain property with the remaining. Then I sold the Beach Mountain and rolled that into my Montana property, which has already appreciated like 180 grand in a year, since I've owned it. So now I've got almost the triple whammy. If I sold that Montana property and the Banner Elk property, I mean, I've probably got $700,000-800,000 in basis because they all roll together, correct?
Mm-hmm.
So, I mean,
Yeah.
and I just want to make sure I'm saying that correctly so I don't screw anything up. I think people don't understand that, Ryan. So that's why I kind of call it, I think that the financial wherewithal behind your investment portfolio, how secure are you financially at home with your IRAs, your SEPs, your cash on hand, your debt, all that type of stuff. And your age plays a big role in deciding if you want to do a 1031 or a lazy 1031. Would you agree with that?
And here's the thing about real estate investors. Real estate investors will you're always told you make money when you buy the property. But I've never ever seen people buy worse properties than when they're in the 1031. I mean, we've seen people that are under the gun that buy these terrible properties that aren't going to perform just because they would rather do that than pay Uncle Sam. I would 9 times out of 10 rather you sell a property normally, pay the tax, keep the cash rather than roll that into a bad investment. Because guess what? If you roll that into a bad investment, well, what's going to happen? You're losing $3,000-4,000 a month, and because you're underwater, right? It's not a good investment property, and you're most likely going to have to sell that at a haircut. It was just like the lady at the boot camp. I don't know if you remember back in November 2022, but remember she had came to us and said that she pretty much took $100,000 bath within 8 months due to operating costs. She was losing money each month, and she lost equity on the sale. And then she had to pay back all those taxes that she deferred because she sold it.
I have some pretty tremendous resources in this industry, as you're aware of, and you do as well. And I've done 6 short-term rental 1031s, which makes up, and I've bought and sold and leveled up, which makes up about $3 million of my $19 million portfolio. Number one, I would never do more than about 30 to 35% of having that portion of my portfolio encumbered with any of those tax burdens. Number two, here's the thing. As Ryan just said, you don't understand the pressure and it's not the 6 months to close, it's the identification process in that first 45 days. And what happens is, like, what I ran into, Ryan, is when I split in Banner Elk and Beach Mountain, I got down. I only had 2 options left on the identification. I had to buy one of those 2 in that 6 months because things were moving way too fast back then. And everybody thinks, "Oh, I'm gonna sell now, or I'm gonna wait for the interest rates to start to drop, then I'm gonna sell, then I'm gonna jump back in, and then you're gonna be in multiple offers, and shit's gonna be flying off the shelf like toilet paper and milk at the beginning of COVID, right? And you're gonna watch those 5 properties go from 5 to 4 to 3 to 2 to 1, and then you're fucking stuck."
And that's a good point to bring up now, right? I mean, we're not economists. We, as real estate investors, we'd like interest rates to go down, but it depends on who you are. If I just sold my first leg of a 1031, if I just sold that property and I'm waiting, I got my 45-day identification, I got that nailed down. Now it's the 6 months to close, and those interest rates go down even 1%. Every 1% that the interest rates go down, another 5 million people can qualify for a mortgage. Do you know the pressure that will entail? Because now you're rolling 1031 money, so you're under the gun. You have to deal with inspection contingency, appraisal contingency, all these other things, competing offers. It deals with a lot of pressure, and I don't think the normal investor isn't ready for that type of pressure.
I would agree 1,000%. So, how do you quantify your advice? What considerations are you looking at from a situational standpoint when you're giving advice to 1031 or not 1031 to your clients?
I've I've never heard anybody talk about this until you brought it up, and I wanna say it was in 2022, and I can't remember what the exact percentages were, but you said, "Hey, I wanna make sure that of my portfolio, I have 30% that is pretty much owned free and clear. There's no 1031, there's no cost seg. I got another percentage that, there's no 1031, but maybe there's a cost seg on it." Can you explain that a little bit? Because I think that's
So
important.
I have $18 million market value in my short-term rental portfolio today. I have roughly right around 3.1, 3.2 million that are 1031, right? So those are all encumbered. And I mean, half of that I paid $1.6 million for my Banner Elk property, right? So it's only like 3 properties. So then I take roughly about another 30 to 35% that have cost eggs associated with it, or a DSCR product that has a prepayment penalty. right? So that's pushing somewhere between 60 to 70% with both of those. I only have one DSCR with a prepayment penalty, and that was that Banner Elk property that I bought on one of the 40-year, 30-year AMs on an interest only. And now, I do not advocate for most people to do an interest only because you're not disciplined enough to do your own escrow. I do my own escrow on that property. And also, luckily, it does just under $300,000 a year. So I'm very profitable at about 130, 140. So I'm able to pay in reserve. So I kind of like profit first, right? So I take and create my own accounts. And one of it is just labeled escrow account. And I put in $4,000 a month just in that escrow account. And then I sweep that money. I used to sweep it just into a money marketing account, but now that goes into an ETF, that does about 8 or 9%, which is higher than the 4.25% rate that I have. So I'm actually making money on saving that principal. And even within that loan structure, I wouldn't have paid $4,000 a month in principal anyways. So I think you have to be very disciplined to do what I do. So roughly 30%, 30%, right? So that's 60% of the portfolio could have an encumberment. I will never go above that. That leaves me 40%. So I'm not that smart, but 40% of about $18 million that has roughly, let's just say 14 million in equity in it. So 40% of 14 million, let's just call it $6 million free and clear. And that's a very important number because I can go and pay off the debt of those encumberments if I need to. So I'm kind of trying to keep everything at 30, 30, and then, roughly around 40. But also I want to make sure I have enough equity in that 40% to be able to pay everything off as I can. Because, my life plan, my strategy is I've got just my youngest daughter gets out of school in like 8 days, right? So that means I have 3 years and 8 days to be debt free. And that's what I think really convolutes this discussion for most people when they're not having a deep discussion with somebody like me or you. They just get the advice on social media and nobody knows their situation, right? Like you and I don't invest the exact same way. We've been friends for 2.5, 3 years. You're in my mastermind. We're on the super team together, all this stuff. And that doesn't mean that we invest identically. And our age difference is a huge differentiator in what you can do and what I can do, but also our risk tolerance. And I think that risk tolerance is something that most people aren't getting. The person that they're talking to doesn't understand their situation, doesn't understand their financials, doesn't understand their risk tolerance, doesn't understand their goals. So they get bad advice.
Yeah, and that's access to cash or equity is the most important part. Because if you're gonna go and if I'm looking at your net worth statement, right? We have people fill out a net worth statement when they become clients, and you don't have 10 to 12% of your net worth in cash or securities like a taxable brokerage account, and you're gonna want to go and do a 1031 and keep kicking that can down the road. You want to always have a backup plan, right? It's like we don't want to just give you the parachute. We want to give you a backup parachute at the same time. And I think too many people, I can't tell you how many people that we consult with where they have $3-4 million net worths, but if I told them go take out $30,000 out of the bank by Friday, they could not do it. And so I think that's where part of your overall financial situation, you have to look at, well, how much equity do I have in my overall portfolio? How much of that is encumbered by cost segs or 1031s? Hey, how much money do I have in cash or brokerage account in case I have to bail myself out? Like, a lot of investors are not thinking about that. They just hear, oh yeah, just do a 1031 exchange, kick the can down the road and do that forever.
Well, and that's also why I have an extra, it's probably 8 to 10% in that second bucket that could be encumbered with a cost seg. Much more flexibility with a cost seg, right? There is a pretty significant recapture in those first 5 years. And that's one of the reasons that I would put more. And as my 1031 number, as that debt gets paid down, I might increase my cost seg, but I always want to stay at like 60% or below in my encumbrance. And I usually keep about $600,000 in investment cash, right? I'm very high on my liquidity, higher than I've ever been on my liquidity today. And the reason for that is because we are in an election year and I am slightly nervous as to what's going to happen. And I think as you get a bigger portfolio, dollar-wise, debt-wise, you need to make sure that you have cash in case something happens so you can sustain going through a down period. It's inevitable. At some point, we can't stay on this path forever. And we've seen that retract a little bit, in 23 and 24, and the economy slowed down a bit. But I mean, stock market's still roaring, real estate's still roaring. And I think the one thing about the real estate side, Ryan, is we are not picking up pace on new inventory. New construction is, we just do not have enough inventory. And I think that's the biggest thing that I look at. You mentioned it earlier. Especially going into summer, if somebody's going into a 1031 now or in the next 5 to 6 months before the election, and like you said, if I don't think interest rates will drop before the election, in my opinion, but nobody knows. You maybe see a quarter, half a point, but I don't think you're going to see a full point. But if that did happen, it would be a fucking onslaught, for people jumping in and buying, and specifically in the markets that most people want to invest into.
Yeah, and that's part of the timing, right? Is let's say you're selling a property September or October, and you're going to go into a 1031 exchange. Well, you're going to have your 45-day identification period, but you may not know until after the year's over whether or not you successfully do the 1031 exchange. And by that point, let's say it does fail, you're screwed. That tax bill is due April 15th. And I think that's where we talked about the timing of when you sell properties and you liquidate is extremely important, because if you're selling a property right now, as we're filming this podcast in early May, well, let's say the 1031 does fail after 45 days or 50 days, however, whenever it fails, that's where that lazy 1031 exchange comes in, because as long as you sell your first property and you buy a property and put it into service before the end of the year, you can do a cost segregation study on the new property to offset the gains from the sale of the old property, right? And so without the headache, because when you go to a 1031 exchange, they hold on to your money in escrow, they hold on to it, the 1031 company. When you do the lazy 1031 that we're talking about, you have access to that cash. It's on your discretion whether or not you take it and invest it in another property. But at the end of the day, you can always calculate, well, hey, here's the equity that I'm going to have, $250,000. I'm going to walk away from the closing table with. If I don't move it, well, I'm left with $200,000. Now, let me tell you, as an investor, I don't want to hold on to that money. Okay. This is why real estate's great, why business is great, because if I have a $250,000 gain, you could be sure that I'm going to have to pay some taxes on that. Right. So number one, I take the tax hit. So now that $250,000, it's down to $200,000. But then the longer that money sits in a bank account, it's losing value to inflation. Okay. So after that first year of just sitting there, that $200,000, I mean, the government tells us inflation's 5% a year, but we all know like it's probably 10, 12%. Just look at the price of milk, eggs, or gas recently. Right. So that $200,000, maybe that's only worth 180 now, purchasing power wise. So there's this fine balance between rolling your proceeds into more properties or more investments, while also figuring out, hey, I do not want to hold on to this money in my bank account forever, because I'm going to lose value to inflation and I'm going to have to pay a lot of taxes if I hold on to this money too.
I agree. Those are all valid points. By the way, what are you paying a gallon for gas? You don't pay for gas anymore.
It's like
I'll bet it's between $4 to $4.50 in Chicago, though.
Yeah. Oh, yeah. In the city, it's easily over $4. It's like $3.80 out here in the suburbs, so it's easily over $4 in the city. It's probably like $4.20, $4.30 in the city.
I think you made some extremely valid points. I really want to make sure that all of you guys that are out there watching and listening understand what we're talking about. This is so situational, and Ryan dropped some really insignificant knowledge bombs there. I appreciate you joining me, Ryan. Thanks for doing this. And if you guys want to hook up with Ryan, he's at Learn Like a CPA on Instagram, and I am Bill Faeth 73. You can see it right down below us, Bill Faeth, Faeth 73 on Instagram. I'm happy to answer any questions for you. I know Ryan is as well. Learn Like a CPA. Thanks for joining us. We'll see you guys on the next episode.
Thank you for listening to STR Unfiltered, where we give you actionable episodes without the bullshit.